Well, hello again. Welcome back to my channel. Thanks for joining me once again. I've just recently been talking about debt, and you may recall last week I was discussing the bit of a mess that Collection House got itself into. It's got into receivership, and part of the issue was the level of debt that it was carrying and was unable to service, really. And I thought I'd just discuss this a little bit further today. Here's a couple of examples of companies where debt really doesn't seem to be much different between the two of them. Company A and Company B both having a debt of $100 million. But here's where the problem comes. We need to also consider, in relation to that debt, what's happening with their earnings. Now, in the case of Company A, it's got annual earnings of $30 million, so it's very well placed to manage that debt. So in this particular case, debt is not really an issue for the company. It's probably paying maybe 4 or 5% per annum interest rate on its debt, so that's $5 million liability they have there. But with earnings of $30 million, they're very well placed to manage that debt. But if you look at Company B, on the other hand, with that interest obligation of $4 to $5 million a year, with earnings only being at $1 million, they're in a little bit of pain. But they could be avoiding that pain if they did happen to have a lot of cash on hand. And so here's two companies where two of the three metrics that I like to look at, debt, earnings and cash, two of those three are the same and one noticeably different. And because of that difference in earnings, Company B would be not a company that I would be very much interested in putting money into for the very long term. Nonetheless, because of that cash that they have down here at 50 million, despite the fact that their earnings are not enough to cover the debt obligation, in other words, the interest on the debt of 4 to 5 million, they can dive into the cash to pay off that debt. So it could be, for example, this company has had some short-term headwinds that it needs to work through, and going forwards the earnings are perhaps forecast to improve over time. So perhaps you do need a more nuanced look at the balance sheet, so to speak, of the company. But for my perspective, I tend to focus on net debt to equity, and I did get a question asking me to go through the calculation of it and how can we get it, particularly from a free site. Get it easily from Stock Doctor, but from a free site, not necessarily that easy. Equity, of course, is the difference between the total assets and the total liabilities of the company. In fact, it's sort of a way of imagining what you would get out of the company if you wound the whole company up, sold all of the assets and then paid off all of your liabilities, and whatever's left is called the equity in the company. And the net debt to equity calculation is the difference between debt and cash divided by the equity. So you're just basically comparing really what is the net debt position and comparing that with what is the equity in the company. And it's just a ratio. It doesn't give you the answer to every single question that you could possibly ask about a company. It's just one piece of information in the puzzle. I like the fact that if a company's got more cash than debt, then this top line becomes negative, and so net debt to equity would be negative. And I like companies that are like that. But as I said, a company could have quite a reasonable level of debt, but provided their earnings are strong, or provided they've got lots of cash in the bank, then they are perhaps able to manage that debt level quite well. Well, anyway, I'm just going to go through how you would go about calculating the net debt to equity using Westpac. It's a free service. You just need to sign up and get a trading account with them. That doesn't cost you anything. And on their site, you would go to the trading tab, come down to company search. And once you're there, you will be confronted with this section down the bottom here, which has got a whole bundle of categories you can go to. So you work in this little region in here. From that, you select the balance sheet, and out of the balance sheet, you're then going to find the book value, which is another word for the equity. We're going to get the cash, and we're also going to get the total debt. And from there, be able to work out the net debt to equity for a company. Okay, so here's a little tutorial on using the Westpac database and scanning tool to help us work out the net debt to equity for all the companies in the ASX 300. Now up at the top here, I've just got fuzzed out my account details, so that'll just sort of stay there fuzzed out through the tutorial, but let's get going. So first of all, we need to select the category, and we're going to go to company statistics, select the field, and we're going to go to indices. At which point I'm going to go equal to, and then we're going to find the ASX 300 index, which is down here somewhere. Where are we? There we go, ASX 300, and we're going to be equal to that, so we'll add that criteria to the list, and it's sitting in there ready to go. And then now we need 3 more pieces of information, all of which come from the balance sheet. So highlight balance sheet, and we're going to select the field. Now the 3 we need are the book value, which is just another word for the equity of a company. We need the cash, and you'll notice that Westpac only gives you the cash for the industrials and also the total debt for the industrials. Now if you're interested in sort of the financials, the banks, you're not going to be able to get it from here, I don't think. So we're going to do this anyway, so let's get the information. So we're going to book value, and we're going to get the display only, so in other words, we just want to know what the value is for that. So we add that criteria. Coming back to the cash situation, again display only, add that criteria, and then lastly we need the total debt for the company, display only again, add that criteria, and then search for it. And we'll get our results down here, and it comes up with 296 results, which is all the stocks in the ASX 300. Now currently it's only showing the first 20 of them, the first 10 of them I think. We need to see the first 200 at least, and here's where the clunkiness of the Westpac platform comes to the fore, in the sense that you can't export any of this to Excel. And so the only way you can get around it is to highlight all of the results. And at the moment we've only got the first 200 of them, so we've come down to Media, and the rest of them are over in the next page. So we're going to start here, highlight up to the top, keep going, here we go, and including the ASX code. So Control C to copy that, fire up Excel. Okay, and then basically I'm going to paste special Unicode text. Okay, now by putting in Unicode text, it gets rid of a lot of the formatting sort of issues that might be built into the results that you've got. Let's format and auto fit the column width, so we've got it all there. And all we need to do now is go and get the remaining 100 or so that we haven't got. Now you notice that cash and total debt here for Abacus, Australian Financial Group, doesn't exist, ANZ Bank. So as I said, we're not going to be able to do the net debt to equity for anything from the finance sector because the data won't be here. Anyway, back to the Westpac page. I think we've got to come down to the bottom here and fill in the next page, so page 2, and again there we go, starting from Aurora Limited and running all the way down to the very bottom to Zipco. So highlighting all of those, so having highlighted all those, Control C, come back to our spreadsheet, which is this one, and we can then append that to the bottom of the spreadsheet. So again, right click, paste special, Unicode text. Okay. And there we have it. We have the ASX 300 and we have all the data that we need. Now I'm just going to put in here at row 2, come to view, and then freeze panes and freeze the top row. Now by doing that you can see that the numbers as I scroll hide underneath the headings there. Now I'm going to add another heading in here, which is going to be the net debt to equity. Now none of this you need to do if you've got Stock Doctor, and I'm sure if you're subscribed to another data provider, something like Stockopedia or something like that, then of course you'll be able to get the net debt to equity figure probably from a straight scan. But for those that are looking to get it from a free site, this is an example of how to do it. So the net debt to equity is equal to bracket, and it's the debt subtract the cash. So the debt in F2 subtract the cash in E2 end bracket. Do that calculation and then divide by the equity, which is the book value, and there we go. Highlight that column, come back to home, make it a percent, go to one decimal place if you like, and then fill that down. So double click on that and away we go, and it's all filled the way down. Now you notice all of these hashtag values here. That's coming about as a result, of course, that we've got no data in here for companies that are in the financial space. So in this particular case, we've got no interest in any of those. So if we highlight this row and go to data and then filter, we can filter this, and let's go from smallest to largest. And so we've got Telix Pharmaceuticals is the most negative net debt to equity, and then coming all the way down to the bottom, there will be some of these hashtag value things sitting at the bottom, which we can get rid of. Now, another way of doing that is to highlight that there, and then when it says select all, come down where it's got the hashtag value thing and just unclick that and hit OK. And then what you'll find is that all those hashtag values disappear, and they're not there on the page at all. And so there we have it. There's the net debt to equity figures for all of the companies in the ASX 300 that are not in the financial space. Now, the ones that interest me are the ones that have negative net debt to equity, because I like companies to have more cash than debt. Doesn't mean to say that some of these companies down here with positive net debt to equity aren't good businesses, but the higher the figure becomes, then the more liable to be under pressure if interest rates continue to rise, these companies are going to be in. Because as interest rates go up, the repayments on their debt, when they try to renegotiate the terms of their loan, will go higher, because with higher interest rates, if they are unable to pay off that debt, then those repayments are going to increase in size. Anyway, that's how you go about finding the net debt to equity. And as I said, in Stock Doctor, you can just scan for it straight away and they'll all appear here. Now, right now, these numbers, many of them are going to be quite different from what you find from Stock Doctor, because the Westpac database is done on an annual basis. And so for many of these companies, these figures are really pretty much pointing back towards the end of June of 2021. However, we are now coming up to the new reporting season, and so you'll be able to use this when companies do report. So once we get to, say, the end of August, if you run this scan, the bulk of the companies will have reported and their results will appear in the Westpac database, and so these net debt to equity figures will be very current, and hopefully will be able to help you in your decision making process. Now, debt is an important part of the puzzle, but not the only thing that needs to be considered in my view. In fact, a scan of Stock Doctor's database shows that there are 1,336 stocks listed on the ASX that have negative net debt to equity. That's like around about 65% of the companies. At first sight, you go, oh, well, that's quite good, isn't it? They've got a lot more cash than debt, so they're quite well placed. But in their opinion, only 189 of those are financially healthy, which is sort of fascinating, isn't it? That's quite a small number of these stocks which seem to be okay, got their debt covered, so to speak, got more cash than debt. But Stock Doctor's saying no, only 189 are financially healthy. Now, many of these companies, as I said, have negative net debt to equity, though, and it's because they obtain their funding through capital raisings. And in most cases, I suspect that's because they are not able to secure loans because their business is regarded as being speculative in nature. In fact, I think about half of these companies here are actually mining stocks which are at the exploration stage. They have no income, And it's unlikely that someone like CommBank or NAB or whatever is going to listen to a pitch from a group of geologists or whatever is saying, oh look, we've got this prospective piece of land, we'd like to borrow 20 or 30 million dollars to go out and dig some holes in it and see if we can find something. A bank is not going to be interested in that sort of thing. And so therefore they come to the stock market and they issue shares in the company, and people who are interested in their story will then contribute cash into the business and buying shares in the company. I guess that's why we're finding that the Stock Doctor is saying that there's not a great deal of these stocks that are actually financially healthy. Of course, there's another key element in determining the financial health of a company, and that's its earnings profile. And importantly, as far as share price sentiment is concerned, the outlook for earnings is one of the big drivers of share price action. Now, earlier in the week on Monday, this was a little grab from my feed when I cranked in tell me what's happening with the S&P. US stocks rallied at the cash open on Monday, but erased all of the gains and sold off in late trading amid fragile sentiment and lack of confidence in the market. In fact, yes, I agree, the market is quite twitchy at the moment. It's sort of tending to be a little bit resilient. The market is sort of hanging in there, but gee whiz, the slightest sound of any sort of negative news and the market does sell off. And so at the closing bell, the S&P 500 dropped 0.84% back down to 3830, re-entering bear market territory. In other words, down more than 20% from the most recent all-time high, with healthcare, utilities and communication services leading to decline, but energy bucking the trend. The Nasdaq, meanwhile, fell 0.89% after failing to break above its 50-day moving average. And it's sort of these technical features, I guess, of the chart, which do play on traders' minds anyway, a key technical resistance to watch in the near term. But we come back another day later, and we find the S&P 500 strutting its stuff with the best day in 3 weeks. And I've highlighted here the reason for it. As I was mentioning about earnings, US stocks surged in a broad-based rally as investors assess the earnings outlook, and as speculation grew that the market may have come close to bottoming out. And it is all that speculation and anticipation of what might be happening in the near term which does drive the sort of day-to-day volatility in the market. And so it's that outlook for earnings which is driving the market. And right now, I've got to say that it's sort of confession season. Here we are heading towards the end of July, and I haven't really spotted too much coming out from companies saying, oh, we need to let you know that things aren't going quite as well as what we have been expecting. So, maybe things will happen in the next week or two. Keep an eye out for companies which are reporting that they're going to have a poorer report than perhaps was initially thought to be the case. But right now, it seems to be that, as I said, the markets seem to be quite resilient, and so far so good as we head into reporting season. Now, as we get towards the end of August, if you're using Westpac or some other service that provides you with all of the financial data that you want, you're going to have a pretty good view of where the market is at, where companies are at, as far as their outlook going forwards. And I guess we just need to keep an eye out for what do the companies say about what they think is going to be happening moving forward over the next 6 to 12 months. Just to finish off today, I do want to go through another example. This is an individual company, and I did own it, but it's an example of where the numbers are telling the story, and really we just need to be mindful of what is going on the balance sheet for a company. Now on screen we have some financials for Temple & Webster, which had been a market darling up until about 6 to 9 months ago, and data again coming from Stock Doctor. We can see that the net debt to equity position was always excellent, way more cash than debt for the last 7 rolling 12-month periods. And for that matter, revenue growth has also been stellar. It's been consistently growing its revenues, and so you'd think that things should be going okay for the company. And in fact, for the 12-month rolling periods to the end of June of 20, December 20 and June of 21, EPS growth was very, very strong. And in fact, I was an owner of the stock at that particular time. And because of my decision to wait for the next set of financials to come through, I didn't sell out of the stock until it reported its December 21 results, and we see that EPS growth had fallen to negative 53%, and that was just an automatic straight exit for me. However, there were signs that I didn't pay attention to, I didn't spot it, and that's where you do need to be a bit careful, I guess, and that's this little figure in here. You'll notice that even though EPS growth was up by nearly 60%, that is on a year-on-year basis. In other words, they're comparing this figure with 1 year ago, which is back there. So at June of 20, the net profit after tax was $8 million. At June of 21, it was nearly $14 million. And so you'd think that, okay, based on that, the company is doing very nicely. But I think we need to have, as I keep using this word, nuanced. I think we do need to be a little bit more nuanced in our approach, and we need to have a look at the fact that on the previous 12-month rolling period, earnings had grown from nearly $3 million up to $18 million. That's profit, that is, net profit after tax. And then 6 months later, the 12-month rolling net profit after tax growth was only from 8 million up to 13.9 million. And so therefore I believe that this was a sign that things were starting to ease off for the company and that it might be time to consider getting out. Now remember, there are about 2,000 stocks you can put your money in, and I think if there's some warning signs, unless you can come up with some sort of a reason as to why you think this is just a one-off blip, that you don't need to be invested. You don't have to be in there all of the time. And this particular one here, I think, is a prime example of a decision that I made that was way not in my best interest. The big warning sign was there, but I didn't spot it, and I hung on for another 6 months. And when you look at that, this is where I could have been getting out when that warning sign first appeared, up here around about $13, $13.50, having bought back down in here at a lower value. But no, I waited 6 months and then got out down here, and so the net result of all of that was what could have been a very nice, profitable investment turned out to be pretty much a tread water overall. So, you know, that's the story there. Thanks so much for watching. If you want to sort of pick up on a few more of my musings and my ideas, you can visit me over on Patreon over there. Until I catch up with you again next week, hopefully you'll be able to join me, that you find my stuff informative. And as always, I hope you continue to keep very well.